Markets got crushed yet again today with the S&P 500 closing down by more than 2%, which is actually its sixth time of the year that it's been below 2% on one single day, which is already more than all of the 2% down days we had last year. In tonight's video, I'm also going to show you that it's not just the 2% down moves, it's the 1% down moves. We've already exceeded the 1% down moves in every other year going all the way back to 2015 so far just this year, and we're not even halfway through it yet. So we continued the volatility here today. 96% of the stocks in the S&P 500 closed lower. So we'll see how that affects our posture. Then I'm going to show you a trade application example where I'm going to focus on a dividend aristocrat that's setting up nicely for a sold put. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 9th, 2022. First of all, welcome aboard. If you're new, remember to go over to YouTube, click subscribe on our channel, then go into the description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Those emails will also give you a heads up as to which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ, and I really appreciate those of you that click like and retweet on those Market Outlook related tweets in particular. Lastly, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, with that out of the way, let's go ahead and jump into today's trade activity. And my, oh my, what a disappointing day it was. In particular, the last hour or so just was kind of a nosedive into the closing bell. And as we take a look at our S&P 500 heat map here, that should not come as a surprise. It's hard to find much in the way of green on this chart. In fact, we'll find out here in just a little bit when we look at the market breadth numbers. We were well into the 90th percentile plus in terms of stocks that closed in the red here today. So the winners were few and far between. Now, one thing I did want to point out, because when you were last with me on Tuesday, I was mentioning that Amazon's square or rectangle was too big on that day because that was just after they had done their 20-for-1 stock split. So good job to all the folks over at Thinkorswim. It looks like that has been appropriately corrected here. It looks like we're back to our normal sized Amazon box. And speaking of which, it was down 4% here today. And so not a great day there for Amazon. But just as soon as we get rid of that headache, we have another headache on our hands. And we'll see how fast they correct it over at Thinkorswim on this one. Facebook actually changed their ticker symbol today. They no longer will be known as FB in the stock market's eyes. Instead, they will be known as Meta. And so this FB does show up in the green here today, but again, that is just a glitch. That didn't actually happen. Meta itself was actually down like over 5% here today, so it's just that Thinkorswim needs to swap that out and get the new ticker symbol in there, and I'm sure they'll probably do that here pretty quick. I have to imagine that, especially on these larger, more well-known companies, they probably receive a lot of phone calls and support notes and things like that that encourages them to get that rectified sooner rather than later. So you can even eliminate that one random green square right there. That isn't actually accurate. There were a handful of others. Home Depot and Lowe's managed to catch a little bit of a bounce here today. AutoZone, Tractor Supply, Starbucks, which I think is benefiting a little bit from the reopening in China. We had Dollar General, which is kind of a more trade down type of retailing experience, and then Costco you could kind of put in that same vein there as well. NXPI was up based off of a one-off story where there's rumors floating around that it could get bought out, and then it looks like maybe Fortinet was up there as well. So it was pretty bleak. not a whole lot out there. Just a little bit here and there. There's one of the aristocrats that was up today. Air Products was up a 0.5%, one of the stocks that we actually bought a few months ago in my DGI class and are still making some pretty good money off of. So, you know, there's a few things that we look at with a glass half full, but to be honest with you, if you were looking at today's market through the lens of a glass half empty, I can't say I blame you. It was an ugly day out there all the way across the board. which is part of the reason you heard me say on Tuesday. You may remember that I've actually done 2 bearish trades in a row, which is somewhat rare for my market outlook applications. I probably tend to do a few more of the bullish types of trades. But on Tuesday, I did a bearish trade. And on last Thursday, when I did the video before that, I also did a bearish trade. eBay last Thursday and then FMC on Tuesday. And what I was saying at that time on Tuesday is, we had to be brave to do bullish trades while the market was in its downfall in the several months leading up to this recent bounce. And equally, we need to be brave to do bearish trades when the market seemed like it was on more solid footing. And I know that's hard to do, but we need to kind of almost force ourselves to do it if we expect choppy markets, which I do. And so I am at least thankful that we have some of those bearish trades going that set us up in anticipation of a really ugly sell-off day like we experienced here today. In terms of some of the biggest losers here today, throw a dart, have at it, right? Pretty much all of the stocks are big losers today. But some of the brighter colored squares, here's one. Moderna was down nearly 9 or 10% here today, so that was one of the uglier ones. Looks like we have a bunch of these brighter squares here, and it looks like it's in the travel space. So Expedia was down 6%. Carnival was down 9%. Royal Caribbean was down 8%, and then Norwegian Cruise Lines down 9%. So really ugly price action there in the cruise lines here today as well. But, don't want to pick on them too much, because the truth of the matter is even the highest quality stocks out there probably got a gut punch here today if you were just to look at all of this. It was bad news bears out there today. Let's go ahead and kind of get a different sense of it now by looking at our market breadth measures. And you can see here I'm on the normal part of the platform now under the Market Watch Visualize area of the Thinkorswim platform. And I do have the public S&P 500 watch list pulled up here. And as you can see, there were 480 stocks closing in the red today. Yes, you are looking at that correctly. There's a couple of extra companies thrown in there with the S&P 500, partially because Thinkorswim doesn't always, babysit this to the day, and sometimes, one stock gets replaced, but it's not, showing up on the Thinkorswim platform yet, even though it officially happened in the S&P 500 index. Other times there's multiple share classes that might account for that, but in general, this is approximately 500 companies that make up the S&P 500, and out of those 500 companies, we had 480 of them closing in the red today. That was an avalanche of selling that we just recognized there. If you were to convert that into a percentage, that is 96% of the components in the S&P 500 closed down today, with only 4 or 5% that managed to somehow pull off the miracle of closing in the green here today. So ugly day across the board. Every single sector got hit here today. Let's now come on over here to the charts. And whenever we have a big move day, either up or down, before we get into our 4 grids, I like to show you guys this chart 6D. And of course, if you're a premium market scholar, you can follow along with your own charting package. Remember, one of the perks that we give you is access to the 50 plus customized charts that David and I use in our classes and presentations. So this particular chart here, 6D, will show us on a slightly different visual how volatile market trading has been here recently. And I just have the S&P 500 index pulled up in front of us. And as you can see up above, that was a pretty ugly candle here today. And this middle portion of this graph helps us absorb that a little bit better, because as you look at this, you'll see this really big red bar stretching from this black line all the way down to below this orange line. And in the label it says the orange line is a 2% price move, with of course the orange line up atop with the green bars being an up 2% day. But the orange bar down below with the red bars is a down 2% day, and that is what we experienced. Officially, the S&P 500 was down 2.38% today. And one thing that I've been trying to point out to you guys here regularly in calendar year 2022 is how much different this year has been from last year. And if you were to kind of lop this graph in half and look at the left side and then look at the right side, it is a night and day difference. Over here, because this is a 1 year look back graph that we're looking at, so this will stretch back into 2021. Look at how nice and gentle those movements were back then. Boy, it sure was nice. We didn't know it at the time, right? We could use getting back into that easy type of market atmosphere. But notice how these green bars and these red bars don't really stretch dramatically and in big numbers. You have a few sporadic ones here or there, and that's always going to be the case because markets will have lots of crazy news to digest throughout history. But in general, you can see this was a reasonably quiet period of time in mid to late 2021. Then fast forward to basically November of 2021 and into where we're at here today in June of 2022, and it is a completely different experience. Notice how aggressive those green and red bars stretching both up and down, dramatic trading all over the board here. And I thought it was interesting because just before I went to go to record the video tonight, I noticed that Charlie had quite an interesting set of statistics that he posted on Twitter. So let me come on over here and tie that into the conversation. I did retweet this, but it just to be clear, it is from Charlie. This is not my data, so I assume that it's all accurate. But anyway, I say this is a great graphic from Charlie. Note the amount of 1% down days we've already had this year, where we're not even halfway through it yet, right? We're not even to the end of June, compared to the full previous other years. Now you premium market scholars know why I've been so much busier this year with my put selling strategy on dividend growth investing stocks. Many of you know, and even if you're not a premium market scholar, I've said it in these free YouTube presentations enough that many of you know as well, that generally speaking, when we have a 1% or more down day on the overall S&P 500, I'm looking to sell puts on stocks that I want to own at lower prices. And I've been repeating myself quite often this year as a result of what I just showed you a second ago, and also this supporting information here from Charlie. So to zoom in a little bit more on this, I wanted to show you that down below here you'll see that it's 2022 year-to-date numbers. This first number here that says 21 is in the 1% down day category. The next number, 6, which actually represents today's trading activity, represents 2% down days, right? Because today we were down just over 2%. And then we've even had some pretty volatile 3% movement days. Last year, in 2021, we didn't have a single day where we were down more than 3%. 2020 was a little bit different because, of course, March 2020 came with extremely chaotic trading with the coronavirus information. But what I find fascinating is in terms of the 1% down movement days, we have already surpassed 2020. Just this year, we have 21 1% down days, and in 2020, we only had 20 the entire full calendar year of 12 whole months. And last year in 2021, we only had 16. In 2019, we only had 10. In 2018, we only had 17. 2017 was an unbelievable year. I was actually just talking about this in my question and answer session today when we were talking about trend trading, or maybe it was yesterday's class. I can't remember which class it was. They all kind of meld together, it seems like these days. But I was talking about how 2017 was an incredible year to be a trend trader. And this graphic will show you exactly why that was the case. We had 0 3% down days in 2017. We had 0 2% down days in 2017. And we only had 4 1% down days in all of 2017. I mean, that is unbelievable to even think about. 2016, we only had 17 1% down days. We'd have to go all the way back to 2015 when we had 25 for the full calendar year to surpass what we've already seen in 2022. So without a doubt, it's almost a guarantee that we're going to take that number out because we've got 6 more months to do it. It is entirely possible that by the end of this year, depending on how things shake out, we could very well be gunning for the amount of 1% down days that we experienced during the great financial crisis of 2008. So that should put that into perspective a bit more for you. These are the days that I'm looking to sell puts, and so it should not come as a surprise that my trade application example later on tonight that I'll show you here in this video will be a put selling opportunity there as well. But for some of you, you might have kind of known that the markets have felt a little bit more volatile lately, but maybe you've never really absorbed or visually experienced the exact statistics behind it. And this graphic here from Charlie, in addition to what I show you guys here on this chart 6D, should put that into perspective. We are dealing with one of the most volatile years that most of you have ever experienced in your trading and investing careers right now. We are in the midst of it. So it has been crazy out there, to put it mildly. Now, no surprise that on a day like this, where the S&P 500 is down significantly, the VIX did go higher. Now, we still don't see the VIX spiking, which is a little bit peculiar, but it was up today, and it went up to about 26 here when it was all said and done. Remember, it was just a few weeks ago we were above 30, and we were still wondering why we haven't seen the spike into the 40s yet. So now we're in the mid-20s, and there's still a lack of true capitulative fear that's taking place out there despite the more volatile trading. So it's a bit of a stranger market that we're in here as well, where certain areas like your disruptive and growth stocks are getting absolutely trounced, whereas some of the dividend areas and blue chip areas and energy are hanging in there a little bit better, kind of trying to balance that out. It's not a one-sided market as we've seen in other kind of black swan event types of eras in the past. So whether we get to that or not by the time this all shakes out, we'll see. But there was a reason that I mentioned on Tuesday when I did the video. So let's go ahead and segue now to the foregrid. There's a reason that when I did the video on Tuesday, I said, I am still a bit hesitant, and I personally don't think we'll be back to all-time highs by the end of the summer or some short-term time period. Obviously, at some point down the road, we will hit all-time highs again, but I am not in the camp that we, are doing that starting right now. I am in the camp that we are going to struggle to make significant progress. It doesn't mean that we have to go plunging lower either, but there's a reason that I shared those thoughts with you on Tuesday. And so maybe I feel a little bit better having mentioned that now, knowing that the markets, of course, have done quite terribly in the last couple of days. But, this always gives markets an opportunity to find their footing as well. If we are starting to roll over again, which it looks like we may very well be, notice that we went up to the moving averages, we struggled to advance beyond them significantly, and now it looks like we're rolling over at the downward trending moving averages again. Notice that 3 out of the 4 charts have those red tips on those moving averages, meaning that price is back below a falling moving average. The only one where that's not the case is the Russell 2000. So, they're rolling over or appear to be rolling over right now. But if during this rollover move, they do not breach those prior lows and they stabilize before then and then have another bounce higher after that, then I think I'll be a little bit more constructive on the markets, because they will have proven to me that they've kind of shook off the desire to have lower highs and lower lows. And that's what we know so far in 2022. So when we got those bullish market forecast postures on Tuesday, and that was another thing I tried to stress to you guys, just because the market forecast technical indicator was saying that the posture was bullish. That is not necessarily David and I's opinion. That's just how you read the technical indicator, right? If there's 200 plus technical indicators out there, and at any given moment in time, you could find one being bullish and one being bearish on the same exact underlying security. So you have to do your best to kind of understand the market environment that you're in, use the technical indicators to your advantage whenever possible, knowing that you won't be perfect on that count. But because those moving averages continue to be going lower, I still had that more hesitant mindset about this market. If they go down, let's say we're rolling over right here, and let's say that the S&P 500 has a hard push lower and sells off to like 3,900 or something like that, but then catches a bounce there before breaching 3810 and starts to bounce and rolls back higher again, there will be enough sideways type of movement here in the past month and a half where you could legitimately see the 30-day moving average stop going down. And if that's the case, then again, that's what I would consider to be more constructive charts for bullishness moving forward. But if we're rolling over right now and we end up taking out those lows below 3,800, all bets are off, right? We're still in the midst of very bearish types of trading. We might not be in a bear market per se, but we certainly have bearish trends all around us, right? Some of you saw my post to Twitter regarding that here just a little bit earlier this afternoon when I said this cartoon here pretty much sums up today's open to close on Wall Street pretty nicely with the one-way sign getting accidentally bumped lower. Right? The signs are all around us here on Wall Street that trading has been difficult this year. The bears have come out of hibernation and they are feasting whenever given an opportunity. And today they were given that opportunity. Now keep in mind, tomorrow is another important economic release. We do have some more CPI and inflation data coming out, and of course that is front and center for this market's worries here currently. So it is possible either we have an aggressive snapback rally tomorrow, or maybe today was a sign of things to come, and they're just kind of getting an early start on the selling. So we'll find out that very quickly within about 12 hours or so. So keep your eye on the markets tomorrow. We could have another pretty aggressive Friday heading into the weekend. But as we review these four charts here, be aware, as I mentioned before, the S&P 500 was down 2.38% here today. It is now back to a weekly bearish posture. Remember, that occurs when that green line rolls over and crosses down and below the 50th percentile. Now, for some reason, we have a little bit of a glitch in the label right now, so I don't know if it's because of the real-time data or what's happening there, but I'll have to look into why that might be the case. I didn't restart my computer too, so maybe that has something to do with it. But anyway, typically what should be happening there is when that green line rolls over, you're going to have that bearish posture. Actually, you know what? I take that back. I understand what's going on now. I wasn't thinking that through properly. Sometimes when I'm on the spot like that, I have to step back for a second, take a deep breath, and remind myself, what am I looking at? Okay, so let's button this up a little bit. When the green line rolls over, if it's between 80 and 50, it will be considered a weakly bearish posture, not a strongly bearish posture. It's when it goes down below 50 that it then becomes a strongly bullish posture. So sorry if I confused you there a moment ago. This is accurate up here. That's why I usually want to make sure that I'm second guessing myself, not the technology. Usually the technology is right. And so in this case, that light pink background color is being painted because the green line is not yet quite below the 50th percentile. It's at 53 and falling right now. If it were to fall below 50 tomorrow, then that background color will turn dark pink like it was back over here again. Notice, by the way, down below, we have the NASDAQ composite chart down 2.75% here today. Now remember, when I was with you on Tuesday, I said the NASDAQ was our current laggard within this market. Remember, the NASDAQ was the only one that did not eventually get some of these dark green background colors to show up. So I was mentioning that the NASDAQ was this current market's laggard and the Russell 2000 was the current market's leader. And so starting with the NASDAQ down here, that makes sense that today was another awful day for our market's laggard. This is our problem child of the market right now. The market has no patience for these speculative growth technology-oriented companies for the most part, and we're seeing that play out right before our eyes. So the 2.75% move on the NASDAQ composite was the worst out of these four that we have in front of us. And notice we now have the dark shaded pink color on the chart. And the reason in that case, as you can see in the label here, is that the green intermediate line is at 46 and falling, right? So 46 is obviously below 50, so that's why you have that color difference of dark pink there versus the light pink up above. So that is more bearish that we're witnessing there. And they're the only one that has a strongly bearish posture. So again, more proof in the pudding that the NASDAQ is our problem child in this market right now, continuing that conversation I already shared with you on Tuesday. In terms of the Russell 2000, continuing that conversation a little bit further, I mentioned on Tuesday that the Russell 2000 seems to be this market's leader, and that was a little bit surprising because we hadn't necessarily been seeing that, previous to that. The Dow Jones kind of has an unfair advantage in the category of a leadership position when the markets are more bearish. You have more of your blue chip stocks in there that retain their value a little bit better. The Russell 2000 is considered to be more speculative than the blue chip Dow Jones Industrial Index. And so it was a little bit peculiar, which is why I tried to spend the time that I did with you on Tuesday pointing that out. And today it emboldens me to say it even further. Because one thing that is odd is that the Russell 2000 was only down 2.12% today. That actually outperformed the S&P 500, which was down worse. It didn't quite beat the Dow today, but the point being, the Russell 2000 usually is more easily manipulated. It's more usually able to be pushed around both up and down, exaggerated movements. And today, the S&P 500 was down worse than the Russell 2000. So that's one sign of evidence that suggests the Russell 2000 is holding up better in this market and is, a quote-unquote relative leader, right? It's hard to call anything a true absolute leader these days outside the energy patch. But on a relative basis, it is leading. And you will see here another piece of evidence is we still, even after today's 2% pullback in the Russell 2000, we still have a strongly bullish posture, which is pretty remarkable if you ask me. Now, part of the reason probably is what I also referenced before. The Russell 2000 is the only one out of these four that is still trading above their moving average. Now, the moving average is back to going lower, which is unfortunate because yesterday you had that brief color change to green where the moving average was rising slightly and price was above it. Today, we still have price above the moving average, but unfortunately, because it was a 2% hit, that plays a role in calculating the 30-day moving average. That moving average is now rolling down once again. But if we stabilize here and we find some bounce potential from this area, it just means that the Russell 2000 is most likely to change its moving average back to green the quickest if we are to see some sort of a rally in the future. That's a big if, because as of this moment in time, it looks like the markets have more of a desire to go lower, not higher, but you just never know when that can change, and maybe it changes with the CPI number tomorrow, and if that's the case, then it's relevant information for you to know that the small caps are starting to pick up a little bit of bullishness there. And, that's something that we actually discussed to a degree in my factor-based swing trading class yesterday as well. Maybe we'll chat about that here in a little bit when we go back over to the internet. But before we do that, I also wanted to point out that the Dow Jones was down 1.94% today. Another ugly day there for the blue chips. You can see that we are back to weekly bearish posture on the Dow Jones Industrial Average. We are back to trading below the falling 30-day moving average as well. So the S&P 500, the Dow Jones Industrial Average, both are back to weekly bearish postures. The NASDAQ Composite is back to strongly bearish postures. And the Russell 2000, despite the last 2 days worth of selling, remains in strongly bullish posture territory according to the market forecast technical indicator. So we have a nice wide variety from an educational perspective of pointing those out. And then of those four charts from a 30-day moving average perspective, the Russell 2000 is the only one that remains above it, kind of pegging it as our current relative leader of this market. You can see its intermediate reading currently is at 67, which is easily above the Dow's 57 and easily above the S&P 500's 54 and easily above the NASDAQ Composite's 46. So that's another way to confirm, okay, it looks like the small caps are taking some sort of a relative leadership role in this market as of this moment in time, and the NASDAQ Composite remains that laggard that has been the case for quite some time. Let's go ahead and step on over here to the internet now. I always like to get a chance to say thank you to those of you that help support these free videos. Remember, these free videos take at least 3 hours worth of our time, and so we need to be able to justify in the back of our mind all the time that we spend doing these videos, because naturally, as busy business owners, we have endless amounts of to-do lists of other things we could be doing with our time. And so we ask one simple request out of you guys is to help support us by clicking like for us on Twitter. And as I always say, as long as we're up and over 100 likes on Twitter, I'll be happy to do a full-length video for you the next time I'm scheduled to do the video, which is why I'm doing a full-length video for you right now, because as you can see, you guys stepped up to the plate nicely for me the last time around, and 115 of you clicked like for me there. And I always like to rattle off some names when possible, just so you can see your names in the lights and so on and so forth, but really just to honor you and to say thank you to those of you who are our most loyal supporters. So thank you to John and Adrian and Dave and Ron and Brian and Irene and Sedona and Fun Jonesy and T-Fib and Claire and Violina, Roger, HR, Tom, Kirkeye, Evan, Ayakipa, Dale, Ruben, Victoria, Ann, Tammy, Jayesh, Paul, Steve, Valerie. There's too many names for me to rattle off. There's 115 of you there, but I see ya. Your names are scrolling past, and we really, really appreciate that. It goes a long way in our book for justifying the time spent on doing these videos. So thanks to everybody who helps support us there. Let's go ahead and check out our factor selector here. I wanted to point out what I just mentioned a moment ago, which is we are starting to see some strength creeping into the low size factor. Now, it's not a perfect overlay, but in general, the low size factor has a close fit with what we analyze at a broad perspective with the Russell 2000 index. And as I just alluded to a moment ago, we're starting to see some perking up with the Russell 2000, so it shouldn't be entirely surprising to see that the low size factor is starting to crawl up the rankings of the factor selector tool, actually in the upper half of the rankings for the first time in over 3 months. Right, there's only 6 factors here, so we don't want to make too much of that, but it is true that it's third place ranking right now. If you were to go backwards with this yellow ball, it had never been in the third place before. It was always in rankings 4, 5, and 6. So this is another way to help us identify that there's something brewing there in your smaller cohort of stocks that we had not been witnessing previously. Now, of course, dividend yield and value factors continue to lead this market. They are benefiting from their defensive characteristics out there. Quality is now at the bottom for a peculiar reason for some, and that is that quality these days is chocked full of technology stocks. In previous decades, that was not the case, but these days, Microsoft, as just one example, is one of just 2 AAA balance sheet companies in the United States, along with Johnson & Johnson. So Microsoft would represent a quality stock and is representative, of course, of the technology area as well. So there's a number of other, software and semiconductor and other, even hardware developers like Apple would be part of the quality cohort, but those are some of the areas that are getting hit the worst right now. So strangely enough, this is a year that is a struggle for the general market where quality stocks, at least from a quality factor perspective, are struggling because so many of the quality ETFs these days are made up of a healthy portion of tech stocks. So it's our dividend yielding stocks and our value stocks that continue to rule the roost here in this market. And while this was put together a couple of days ago, it would probably be even more so the case after today, of course, after another bloodshed type of a day in the market. Also, wanted to point out here real quick that I did teach my question and answer session here today. Remember, David and I each teach 5 classes traditionally throughout the week. David's schedule this week is quite sporadic because he had a joyous moment today as he picked up his son from the airport after not having seen him for quite some time, in addition to him being involved with some basketball camps. So his presence has been a little bit more sporadic this week. But traditionally, David and I teach 10 classes a week, 5 each. Each of us teaches 4 trading rooms, and then each of us has a question and answer session at the end of our teaching week, so that way it gives us a flexible spot to circle back and tighten up the knowledge for students that were attending our classes earlier in the week. So I did teach my question and answer session here earlier today, and as always we had some excellent commentary. I got a question about looking at a REIT stock as a dividend growth investing concept, and a chance to talk about the patience needed to become a successful dividend growth investor. I got a question about how to handle 529 accounts for kids' educational savings, and how do we handle something like that that is relatively limited in its ability to kind of transition into more bearish areas of the market. I got a question about looking at Kellogg's as a dividend growth investing stock. I got a question about Altria as a dividend growth investing stock and how to think about it at a high level, and whether stop losses have a role in the world of long-term investing and dividend growth investing in particular. And so in that particular answer that lasted about an hour, actually just over an hour, I gave as much of my mind about that concept as I could, including some nice analogies about where I grew up right off of the Missouri River and the way that you think about investing from a long-term perspective. So if that strikes your fancy, feel free to check out that area if you're a premium member. And then I had another question about looking at a custom columns tutorial and how to work the TOS Market Watch tab, and how to use some of those custom columns to use ThinkScript to kind of spit out different data like war scores or 1-month returns and different things like that. And then I also got a question about either selling a put or buying the stock of Intel, and how I kind of think through that conversation depending upon the stock in question there. So again, some excellent questions, hopefully some useful responses from me, and it was another 3+ hour extravaganza for those of you that are looking for additional content to fill your day. Perhaps if you're not getting as much content from David this week because he's been so busy, maybe you got some time to listen to some of my presentations there as well. So that's what we had for you there. And then later tomorrow, as far as I know, David will be teaching his technical analysis class, which he usually teaches there on Friday. So make sure you're checking that out as well. All right, let's hop on back on over here now to the platform and go through some more charting analysis. Let's do some 12 grid analysis now, starting with chart 5A. Remember, this will be our asset class 12 grid. And this one will basically give us a sense of a broad approach towards the financial markets generally. This is not just stock market specific here. And so it gives us an opportunity to see both bullish and bearish in most cases. So let's kind of go through what's catching my eye here today. First things first, let's talk about interest rates, because that seems to have been one of the storylines of 2022. And interest rates continue to bounce from that 30-day moving average. We did see interest rates close above a 3% yield here again the last couple of days. Remember, on the Thinkorswim platform, if you pull up TNX, you just move that decimal point off to the left one, and that will tell you what the 10-year Treasury yield is. So at this moment in time, the 10-year Treasury yield is at 3.04%, and it was up again here today. Not only was it up, But you can see we're back to a strongly bullish posture from a market forecast perspective. That's what that dark green background color tells us. You can also see that the intermediate reading is at 65 and rising. And then you'll also see here that the 30-day moving average is green colored once again, telling us that price is back above a rising moving average. So we had a little brief kind of, take a breather moment here for a week or two, and then we're back to those stubbornly high interest rates once again. Because, again, inflation continues to be a problem for this market, and the market's expectations is that we've got a lot of interest rate hikes in front of us from the Fed in order to cool off that inflation. So that's showing up through the lens of the 10-year Treasury yield. Now, the flip side of that, remember, when interest rates go up, all else being equal, bond prices themselves go down. And we largely saw that today in things like foreign bonds, which were down 0.58%, and even high-yield bonds were down 0.8%. That has been a disappointment. I was kind of optimistic here that high-yield bonds were catching a bid during this 5-day rally where maybe we were going to be off to more of a risk-on marketplace again. But you can see how quickly that has been unwound, and that is no longer a benefit to this market. Right now, it might have just looked like it was a dead cat bounce type of a situation. So we've gone down equally as fast as we went up, and that's no longer a supportive piece of commentary for the markets at large. The long-term treasuries themselves were up just a touch here today, up 0.33%. But I wouldn't make too much of that, given the fact that all three of these bond categories all have dark pink background colors, telling us that we have strongly bearish market forecast postures, and all three of them have moving averages that are pointing lower, and their prices are below those falling moving averages. So not a great look for the fixed income markets at this exact moment in time as a result. On this bottom rung here, I should point out something different that was not the case on Tuesday. Remember, on Tuesday, the US dollar was bearish at that moment in time, had a bearish posture or a pink background color. Notice today is different. We had a pretty big day in the dollar. The dollar benefited from more of that risk-off mindset. Remember, the dollar is perceived as a bit of a safe haven asset, all else being equal. And so when stock market is selling off violently, that money has to flock somewhere else, and sometimes it finds itself into the currency markets, and the US dollar is kind of perceived as the most liquid, best house in a bad neighborhood, right? Because pretty much all the central banks out there have kind of inflated their way to the position that they are at right now by, money printing presses that are out there. But it is the US dollar, I suppose you could say, is the most prudent of most of those that are out there, because they're the ones getting the most serious about raising rates here, and that might very well be showing up in the US dollar at this moment in time. So we're back above the rising 30-day moving average on the US dollar, and we're back to a weekly bullish posture. So it'll be interesting to see where we go from here, but we've got a little bit of a curl higher here where we could pick up some steam to the upside once again. Remember, this cooled off significantly last time when we got these overbought cluster signals. So could we work our way back up to that area? It's entirely possible. Let's keep our eye on that possibility. The gold market was a little disappointing today. Likewise, the conversation I mentioned with the US dollar, gold can sometimes benefit when we have a chaotic risk-off type of market day, which today was. But you did not get that benefit today, partially because of what I've already said about the US dollar. Remember, all else being equal, if the US dollar is strong, then commodities and foreign assets are going to struggle on a relative basis. So note that both gold and oil closed lower today. Gold, that's been kind of par for the course, right? Gold has just been kind of stumbling all over itself, not really getting its footing anywhere in recent months. Oil, on the other hand, has been like a one-way freight train to the upside. So it was kind of rare to see a down day all of a sudden here for oil. You haven't seen a lot of those recently. So I think we can probably blame the strong dollar today for the sell-off in commodities, and then notice how the foreign stock markets up above handled things. And they did not handle them well because EFA was down 4.22%, and that covers your developed foreign stocks. EEM, which covers the emerging foreign stocks, was down 3%. Both of those moves were worse than the S&P 500. And remember, the S&P 500 had a bad day. This is considered a pretty terrible day in the United States, but things were even worse overseas. Again, probably because the US dollar was so strong. Now, of the two, notice the extreme difference between EFA and EEM. EFA is now back below its falling 30-day moving average and back to a weekly bearish posture. EEM, on the other hand, still has a strongly bullish posture. It's actually in the upper reversal zone, if you can believe it, above 80. You look at that chart, and it's probably hard to believe, but remember, if you right-click, go to Maximize Sell, you can actually see that green line in the upper reversal zone. So this is a kind of a goofy-looking chart. It's not that you would have predicted that ahead of time, but you're really close to falling out of it. So if we have another down day tomorrow, it's entirely possible we go back to a weekly bearish posture on EEM tomorrow as well. But for this exact moment in time, while we're just barely above 80, we do still have the strongly bullish posture. But also, to be fair, we're still above the 30-day moving average, which that's definitely not the case on EFA. So I don't know if you guys have caught it, but in recent days, a lot of the Chinese tech stocks have started to catch fire a little bit. Alibaba was up like, I don't know, somewhere between 10 and 15% yesterday. And so there's been a little bit of a relief rally in some of those Chinese names. Today it didn't really pan out, but in days leading up to today, those Chinese tech stocks, I think, have really added a little bit of an adrenaline push into EEM in general. So I think that explains the difference between your developed stocks and your emerging stocks right now. The difference is how all of a sudden the Chinese tech stocks are starting to catch a bid all of a sudden. Let's now take a look here at our Sector 12 grid. This will be chart 5C for those of you who are premium members following along at home. And after having such nice bullishness in recent weeks, we've now reverted back to bearishness once again, with the only standout performer being energy. I paused for dramatic silence there because, of course, you guys already know that's the case. As I was joking with you on Tuesday, I know I sound like a broken record when I say it's energy's world and everybody else is just living in it. And the proof is in the pudding. There's only one chart on the board that looks like this one, and for good reason. This is deserved to have a strongly bullish posture. This is a great looking trend. All of the rest of the charts on the board do not deserve to have a dark green background because none of the rest of them look anything remotely close to energy. All of the rest of them look pretty pathetic in comparison. And so we didn't want to get overly ambitious with our recognition that many of those charts went to weekly bullish in posture, even though many of them were still trading either at or below their moving averages. And so that's why you never really heard me get aggressively bullish in my commentary here in the last week or so, because I still felt like there was a lot of work to do, and I still feel that way right now. Energy looks great. Everything else looks mediocre at best and downright ugly at worst, right? Real estate all of a sudden looks terrible. It is falling off of a cliff here. Staples look terrible. They're plunging here today as well. Healthcare is plunging here today. Utilities are plunging today. Remember, that's pretty odd. Usually your bottom rung here, which represents the more defensive sectors, holds up a little bit better in a big market sell-off day. But part of what might explain that is, remember, those areas have held up better on a year-to-date basis, so perhaps they need to play a little bit of catch-up and sell off further in comparison to those other areas that have already taken their licks. So anyway, I found that to be quite interesting today as well. But really, if I'm looking at any of the other charts, nothing compares to energy. In fact, as I look at them, there's not a single chart here other than energy that's trading above its 30-day moving average. Every single other chart is trading below its falling 30-day moving average at this moment in time. Every single one of those other charts has a red tip to it to let us know that, right? Even utilities, which I had said before is kind of like honorable mention. It was in second place, but it was dramatically behind the first place champion of energy, right, is how I explained that. So if there was going to be a candidate that could vie for attention, it might have been utilities, but here we see after just 2 days, we can no longer really make that claim. It's really just energy and everybody else. Even utilities has fallen back below its falling 30-day moving average. So not a great 2-day look for these different sectors that are out there. Now, also to be fair, energy was down today, so I don't want it to give the impression that it was up today. It was not. It was down over 2% today, just like the market was. But it's how we got to this moment in time that makes the difference. All the rest of these charts were already struggling. Energy was in basically a one-way direction to the upside. So it's fair for it to have a breather from time to time because it's been working overtime on behalf of all of us here recently. Many of you have seen my immense amount of ExxonMobil tweets here recently because that's been an interesting educational element as ExxonMobil finally went back to all-time highs yesterday. Proving that patience does pay as long as companies are not cutting their dividends. And in the case of ExxonMobil's illustrious 100-plus year history, it was not a walk in the park in order for investors to finally get back to all-time highs, but they were able to finally accomplish that yesterday. So it's been really fun to kind of talk about that and to learn from, have educational examples and all that kind of stuff. But, you know, Exxon and the like are basically the only areas that are working consistently right now. You might have one-off situations in other sectors that, you know, you get these rumor mills going with buyouts and different things like that that might be causing a few stocks to perk up here or there, but it's not a consistent experience. The only consistent experience to the upside right now is energy, which is why it represents our biggest sector allocation in my Monday top-down trend trading active part of our portfolio. Anyway, let's go ahead and get into our trade application example now. And as I alluded to earlier, I will be doing a sold put trade. That is something that I strive to do when markets are selling off aggressively because on those days, the VIX goes up and you get more bang for your buck when you are selling puts on a day when volatility is rising, all else being equal. Now, the key is selling puts on stocks that you actually want to own at lower prices. And so, as you know, if you've been watching these videos for any amount of time, the sold put trade is by far and away the trade that I've been showing you the most often in 2022 for the reason that I mentioned at the beginning of this video when I was showing you all those green and red spikes on the S&P 500. We had so many red spikes down below the 1% level this year that those are the days that I target to sell puts. And some of you might not still kind of grasp that concept of why are you doing a bullish trade when the stock market is getting hammered? Well, it's for the exact reason of what I did the last two times I presented for you on Tuesday and then last Thursday when I was doing bearish trades on days when the market was up, right? You have to be brave to kind of go against the market on occasion as long as you're doing it in a more prudent style. You can't just be random about your approach. And I'd like to think that we are not random. In fact, one thing that caught my eye here today is how successful we have been with my trades that I've showed you in these free YouTube videos. I am hand delivering to you lots and lots of winning trades here for free on YouTube. Here are all of our open trades in the market outlook category that we have in front of us. And all of them, with the exception of today's trade, which is Medtronic, that I'll talk about here in just a moment, all of the other trades are profitable trades, right? You look at this PL open column, and we are making money on all of our trades other than the one that I just put on today, which, you know, fell into the close a little bit, so I'm down a whopping $5. But we're up $100 on AbbVie, which was a bearish trade. We're up $222 on Best Buy, which was a bullish trade. Comcast, which is a bullish trade, up $32. eBay, which was a bearish trade, we're up $25. FMC, which is a bearish trade, we're up $70. Intel, which is a bullish trade, we're up $8. JP Morgan, which is a bullish trade, we're up $101. Kellogg, which was a bullish trade, we're up $540. That one is a little bit of a strange one because we actually put that trade on a long time ago in this video, but we still continue to hold it. We're up $30 on the NVIDIA bullish trade. We're up $246 on the bullish Q's trade. We're up $65 on the bullish Scott's Miracle Grow trade. We're up $100 on the bearish, actually that's the bullish Stanley Black & Decker trade, and we're up $106 on the bearish Texas Instruments trade. So literally, other than the trade I just put on this afternoon, we are making money on all of our trades that I've shown you here recently. And so that's why I urge you so much to click like for me on Twitter. I am literally delivering for you right now. It'd be one thing if all the trades I was showing you are just terrible trades and we're losing money left and right. I can understand why you wouldn't want to click like, right? But I'm telling you, I'm willing to give you my trade ideas and my time. Remember, it takes me probably a half an hour to 45 minutes to look for proper trade setups for you guys for free, where we don't get paid doing these videos. And so when I urge you to click like on Twitter, which doesn't cost you a penny to do and only takes 5 seconds out of your time, in return, you're being hand-delivered excellent trades here. Now, I've got to be careful because the market likes to serve up healthy portions of humble pie, and it can do it at any moment in time. But this happens to be a time where we are hitting our stride. We are knocking it clean, as they say in baseball. So, do your best to support us, because if we're under 100 likes, then I can't deliver trade ideas to you. So some of you are so against the idea of clicking like on principle, because you don't like to do it if we ask you to do it, that you're willing to cut off your nose to spite your face, right? If you don't do it, and enough of you have that mindset collectively, then I can't deliver winning trades to you and profitable ideas to you either. So I would hope that most of you don't think in that regard, and I would hope that most of you are willing to support David and I by clicking like for us there on Twitter, which is completely free for you to join, and all of you have access to it, because if you're watching this video right now, you're watching it through the internet, which of course is where Twitter is as well. So I know I'm preaching to the choir for most of you, but for the rest of you, that's my little encouragement for you. If you want me to continue to bring winning trade ideas to you, then all you have to do is click like for me on Twitter. Pretty easy, I would say, and you get a pretty good trade-off in the grand scheme of things there, right? You don't have to do any of the work. You just have to sit there and absorb the content and take in the trades. We do the work for you, and we don't really request much in return for that. So thank you to those of you who consistently do that time and time again. Let's talk about our trade idea now, and this is Medtronic. This is one that we've probably actually done sold put trades on before, but it kind of popped up on my radar here again recently for a couple of reasons. First of all, they did just recently announce a dividend increase where their dividend is going to go from 63 cents to 68 cents. Medtronic is one of those dividend aristocrat companies that I tend to focus a bit more of my efforts on. And this is one that has sold off pretty sharply here in the last year or so, from 135 down here into the blue zone. As many of you are aware, once a dividend stock gets into the blue zone of this dividend stair-step chart, it becomes more eligible for consideration for purchasing long term. But we do have one issue at hand right now, which is Medtronic's current dividend yield is only 2.92%, which is attractive compared to its own yield history throughout time. But unfortunately, right now, the 10-year Treasury yield is above 3% at 3.04%. And generally speaking, we'd like to buy our long-term investments when they have yields that are superior to both the S&P 500 yield and the 10-year Treasury yield. So that's where Medtronic falls a little bit short right now. So I thought this would be an interesting example to do a sold put trade on, because remember, what you're doing when you're selling a put is you're basically putting your neck on the line and saying, I'm willing to buy that stock at the strike price that I select lower than where it's trading. And as you probably saw here on the monitor tab, the Medtronic that I did here today was the July $85 put. And I got 84 cents for that. I usually target the 1% return on risk. So 84 cents on 85 underline is basically right at that 1%. So 85 on the chart is approximately right here that I'm circling, which would then make it well in excess of way over a 3% yield and would be well over what the current Treasury yield is as well. Now, the other thing that caught my eye with it is notice that you do have a little green dot showing up under this week's bar for Medtronic. And what that signifies is that on the market forecast technical indicator, using a weekly candle chart, you have an oversold cluster signal. And a lot of times stocks do try to stabilize around those levels. You'll notice, for instance, back here, you had that little green dot showing up in late 2016 that led to a furious rally immediately afterwards. You had some of those green dots showing up late last year in 2021, and while it wasn't as big of a snapback rally, it did stop going down after that, and it went sideways and then eventually went up a bit. So if you're selling puts into a sideways price action, you're still going to make money on that trade. So it's possible that we're trying to plumb the lows here on Medtronic more recently and trying to etch out some sort of a bottom where you could get away with selling puts at lower strike price and have a greater chance of seeing success on those, just like all those that I rattled off on the monitor tab before with the Qs and JP Morgan and Comcast and Best Buy and all those types of things, right? So anyway, this is another one of those sold put trades, the 85 strike in the month of July for a 1% return on risk. Okay, so that's what I had for you here tonight. If you like that trade idea and you want to help support this video, as I mentioned before, all we ask out of you is one simple thing. It takes 5 seconds out of your day and is free of charge for you. All you have to do is click like for us there on Twitter. As long as we're up and over 100 likes, by the time I do this video again on Tuesday, I'll plan on doing a full-length video for you. If we're under 100 likes, then I'll just do a 15-minute video that does not include a trade application. So I'll let you guys decide there in the end. I would imagine that David will be able to get a weekend video out for you as well as things start settling down for him. But until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.